So we continue our discussion about credit cards and installment loans. But first, let me explain the difference between a credit card and a debit card. Now, Visa and MasterCard are two companies, international, that provide plastic card usage. When you have a card that has 16 numbers on it, that number, part of it is assigned by Visa or MasterCard, and another part of it is assigned by the institution who's giving you the credit card. So let's say you got a credit card or a debit card from Chase, JP Morgan Chase Bank. Well, Chase is the issuer of the card. However, Visa or MasterCard is the processor of the card. So a credit card or a debit card may have and should have either a Visa or MasterCard logo on it so that it can be used at those little machines are called point of sale. You know, when you go to Walmart, you slide your card, that's a POS machine, point of sale machine. And they will have a phone connection basically to a center that calls your bank and that basically authorizes payment. So the processor of that transaction is Visa or MasterCard. Now, a credit card and a debit card will have a Visa or MasterCard logo. That means both can be used to make payments wherever you see Visa or MasterCard logos. A credit card will allow you to borrow money. A debit card will allow you to use your money in your checking account. So debit card is very similar to using cash, and therefore you could actually have a cash back after your transaction. And a credit card is basically allowing you to use your credit limit. So a credit card allows you to borrow up to a credit limit. And once you start spending the money, you have a certain period of time that you could make this spending in a month. And at the end of that, you actually have a payment due date. And at that date, you have to make at least a minimum payment. And your statement will indicate how much that minimum payment is. And if you do not, they could actually cancel your credit card, call the loan, or give you a big penalty, increase your interest rate, and report your credit bureau and put a stain on your credit score and credit history. So if you pay within that due date period, then you don't pay interest. And that actually makes the credit card a very useful tool within your financial system that saves you money and that actually gives you a lot of benefits. However, if you pass that due date after you make your minimum payment, then you start paying interest on the outstanding balance. And credit cards are notoriously, they're notorious in charging significant interest rates, and therefore there may be some substantial finance charges or interest charges on the credit card. Who can issue a credit card? Well, store cards are very common. So companies like JCPenney, Best Buy, Macy's, Sears, Lowe's, Home Depot, they all issue store cards. However, if you look at the back of the card, you will see the actual bank who's issuing the card, and then you will also have Visa and MasterCard logos on these cards as well. By the way, not every store card may have a Visa or MasterCard. Some store cards will not have Visa or MasterCard, and that means those cards can only be used at that specific store. Then commercial banks can issue credit cards. So banks like Chase, Citibank, Bank of America will and can issue credit cards. So you need to manage your credit card wisely. which means that you will have a statement. You can have your statement, via mail or online. But every month at a certain date, you will receive this statement. You will have a payment due date. That's the due date that if you make that payment by that date, you won't incur any interest charges. You will just pay whatever you spent, and then you will receive a rebate, and you will receive your fraud protection and your insurance and all the benefits of using a credit card. However, if you make your payment up until this due date, then you won't incur any finance charges. You should note transaction and posting dates. So just because you actually slide your card today and to use it doesn't mean that that transaction will be posted on the credit card on that specific day. In fact, if you actually go into your credit card, the website, you will see pending, and then after a couple of days, you will actually see that transaction posted. If you have any unpaid balance from previous months, it will add up to your overall balance, and your interest will be accrued on the outstanding debt, which means that whatever you owe from current month and from previous months will be your new balance, and you'll pay interest on the current new balance, the outstanding, the total balance. And when you make a payment, the first dollar actually goes to the previous month's debt. So there will be a minimum payment due, and that minimum payment is calculated so that it is more likely for you to fall into a minimum payment trap. However, minimum payment is a must pay. You don't pay, you're in trouble. Your credit score will be affected, your credit history will be affected, your credit may be called, which means that they cancel your credit card and say all is due now, pay, or we'll send the payment to collection agency. So minimum payment is a must pay. There could be some transaction fees, so be careful with this. For instance, if you have, say, a Chase debit card and you want to withdraw some money, and you use Bank One ATM, there will be a transaction fee. If you withdraw some cash advance, there will be a transaction fee. Some POS machines may have a transaction fee. If you use your credit card internationally, there may be transaction fees. So be careful as to when you get a credit card, read the specifics of the credit card and some fine print, however fine they write it. These transaction fees can be surprising and can be substantial. Credit for merchandise returns and errors. So we looked at an example in the previous video, but let's take a look. Chase credit cards. Let's take a look what this means. So let's pick one. Let's say, let's go to this one. So if you look at this one, for instance, this is, I've been seeing this on the TV. It seems to be very popular. They're really pushing for this. But if you look at this specific card, we're talking about the credit for merchandise returns and errors. So this card, for instance, will give you some sort of insurance, purchase protection. So it covers your new purchases for 120 days against damage or theft up to, and every credit card will have some sort of insurance attached to it. And so your credit card may actually have these benefits. But with respect to managing your credit card, you should know the benefits that you're getting from your credit card on top of everything else that, that goes on with your credit card. However, if you return an item and if you noticed an error and you notified your bank, you should be on top of it. Don't assume that they're just going to fix it. A lot of things just go by, and Especially, I've noticed that, you go to a restaurant and then they bring you a check, say $50, and you write a tip, and then say you wrote, I don't know, $15 tip on it, and then now the new amount is 65. On the first immediate transaction, the pending transaction, you're going to see the 50, and then after a week or so, it will get readjusted and include the tip of the 65. Just make a habit of always checking to make sure that it is actually 65, and if it is less, then the person didn't get the tip. If it is, just go back and pay the tip. If it is too much, then something not funny is going on, and you should be on top of it. So, and again, you return an item and they said, oh, it will be posted on your account in 2-3 days, and a week passes by and the money is not there. Give them a call and give the bank a call and say, I returned an item, the money is supposed to be back in my account, it's not in. Please do help, and they need to fix this. These things slip by, and it's money, it's real money, so you should be on top of it. The penalty rates are substantial. So if you don't pay your minimum payment, there will be a penalty rate, which means that if you miss your minimum payment, your outstanding debt, like for instance, in this specific card, it says the card has a variable APR, which we're going to talk about in a minute, is between 17 to 26%. And but if you skip your minimum payment and they give you a penalty rate, it could be as high as God knows what. It could be really, really substantial, scary substantial. And therefore, you should really make sure that you pay your minimum payment. So what is a minimum payment trap? Minimum payment trap is that the bank is going to tell you that you have to pay X amount of dollars as a minimum payment. So say you have $1,000 and they tell you that your minimum payment is $15, and every month you're paying $15, thinking someday your balance will be lower. The fact of the matter is your minimum payment is so low that you barely pay the interest, and maybe a very, very small fraction of the principal. And you could pay that minimum payment all your life and not make a dent on the principal. So personally, what I do is, or what I used to do is, in the credit cards, I used to pay at least double the minimum. However, a good financial discipline is not to have any debt after the payment due date, which means whatever you spend, you pay. So don't pay any interest on the credit card, because that interest is high. 26% a year is a high, very high interest rate. So the minimum payment trap means that their intention is to keep you hooked and have you keep paying that interest without making a dent on the outstanding balance. If there's a fraudulent charge, your car gets stolen, or you notice that all of a sudden there are some charges that you didn't make, notify your bank immediately, and you're not responsible for any charges within the first 2 days. But make sure the state that you're living in and or the country that you're living in has laws that confirms this. So don't take this as a given. Things do change every day, and but this doesn't change. You notify the bank immediately, and having the settings in your account that sends you notifications of every transaction that takes place in your credit card or in your bank account is a good practice. And once you do that, you notice immediately that there's a fraudulent charge to your account, notify your bank, and they will cancel your card, send you a new one, and you won't be responsible for any future payments. And even that specific fraudulent payment is wrong. If there are errors, you have to notify the bank, and the grace period is usually about 60 days after the statement mailing date. Now, this was a credit card. Now, there are installment loans. Installment loans are a little bit different. Now, installment loans are closed-end, which means that when you have a credit card, your credit card is, you have a credit card. and you could keep the same credit card for. I came to Louisiana in 2004. We have a credit card from Chase, and for the past 15 years, we have the same credit card. So you can actually have a credit card and keep it for many, 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 many years. In fact, it's a good practice to have one card, and or maybe two cards, and then keep your the credit limit not too high, so that if the card gets stolen, you don't lose too much money. However, you stick with that. You just don't go back and forth cards, so that you actually create a good, you build yourself a good credit history. But installment loans are closed end, which means they die. So, for instance, you buy a furniture and they give you an installment plan for 2 years. That means at the end of that 2 years, you will be paid off. You have to. So that's what that means by closed end. Installment loans require periodic payments, and that periodic payment will include an interest and a portion of the principal. So these are not minimum payments, because a minimum payment at a credit card intended to get you to pay for it for the rest of your life without making a dent on the principal. However, on an installment loan, what you're paying monthly is actually interest plus a portion of the principal, and they are calculated as such that when you get to the end of the installment loan, you don't have any more loan. It's paid off. So installment loans are closed end, and you pay a required payment whatever the period is, so every month, for instance, and that includes interest plus the portion of the principal. And you miss a payment, then you're at the default. The entire loan may become due, and the collection agency may step in, and it goes to your credit history, it goes to your credit score, and so on and so forth. So these are all very serious payment commitments, and you have to pay these monthly payments. These are not minimum payments. It is what it is. You get an X amount of dollars, you sign it, well, you have to pay that every month. So who can issue installment loans? Any depository institution, Chase, Citibank, Bank of America, Bank One, can issue installment loans. You could have sales finance companies. So you go to a furniture store, you buy $5,000 worth of furniture. They will say, would you like to finance it? And say yes. Then they will go through some payment options with you. You basically are talking to, talking about getting a loan from a sales finance company. Or you buy a car, the same situation. You buy a house for a mortgage, same situation. So these sales finance companies is not necessarily a bank, but these are companies that provide installment loans. Consumer finance companies also make small cash loans. You also have, which we're going to talk in a minute, payday lenders, rent-to-own programs, pawn shops, and secure credit cards. These are all alternative loan companies. So there are something called a single payment loans that are not as common. However, this is also common for commercial enterprises. These are repaid as a lump sum at the end. So, you borrow $15,000 in 2 years, and they say 10% interest. You basically pay the interest plus the principal at the end of the 2 years, and that's a single payment loan. You sign a loan contract. Whenever you borrow an installment loan, it will include what are the rules of the account. It will include your repayment pattern. Most of the time, it will include the dates of your expected payments and amounts. Some of them actually may give you what looks like a checkbook that you basically tear one page and put it in an envelope and send the payment. And some of them may just give you a schedule of payments, the dates and the times and how much, and you're expected to follow that because you're signing a contract that says you will, and if you don't, they will come after you. It will include how much interest rate you're paying and what fees are associated with it. If you actually pledged any sort of collateral, then that collateral is also part of that contract. Installment loans can be secured versus unsecured, which means if it is secured, then you're putting some sort of a collateral. If it is unsecured, then there is no collateral. A collateral can be your car, your house, cash, something of a value, or it can be a cosigner, a person that has a very good credit score, person that has a very good credit history, just simply says if you cannot pay, he or she will pay. And a cosigner, it can be a collateral. The contract may have an accelerated clause, which means that the principal and the accrued interest immediately payable. Now, this may be both ways. However, most commonly, it just means that you could pay it off early. So this paid off early works like this. On consumer loans, installment loans, so let's say that you bought a furniture for $5,000 and you promised to pay X amount of dollars every month, principal plus the interest. But that is if you actually keep up the loan for 2 years. But the fact of the matter is you owe them $5,000. Now, you make the first payment, you will owe them a little less. You make the second payment, you owe them a little less. But every time, what you're paying is the interest on the outstanding loan. So let's say that somebody gave you some money, your parents gave you money, and you felt like, you wanted to pay the entire $5,000. If it is included in the loan and it is allowed that you can pay it off early, then you simply say, I want to pay it off. Then you pay the outstanding loan and you're not responsible for the future interest that's supposed to accrue on this account. Now, not every loan allows you to do this. Some loans will say, look, we signed a contract. Even if you wanted to, you cannot pay it early. So make sure that you have that clause in the contract that says you can pay it off early. Confirm a couple of times just to make sure that if you want to, you can pay it off early. Because if you cannot pay it off early, that also means you cannot refinance that loan. Because refinancing simply means that you actually get some money from another loan company, pay this one off with that one. But you were paying 5% to this guy, and therefore that was high, and now you just bought out at 2%, so that's significantly lower, so you refinanced it. So if you cannot pay it off early, you cannot refinance it. If you cannot pay it off early, you cannot pay it off early. So be careful to have that clause in the loan that allows you to pay it off early. If there's a deficiency clause, and it will have a deficiency clause, which means that if your collateral is insufficient to cover your debt, then they could call the loan, which means the remaining amount will become due. So let's say you bought a car, $20,000, and you put a collateral, some equity or some sort of collateral, and it turns out that it became insufficient. The loan company, the creditor, could simply say that the collateral is insufficient, either put up new collateral or pay it off. Well, I don't have the $20,000. How am I going to pay it off? Not their concern. Pay it off. But we agreed you were going to give me 2 years, 5 years, whatever it is, that I make the payment. It's paid off. So they basically just call it quits. They want their money. So if there's a deficiency clause, they can do this. If there is not, which there will be, but if there is not, then they cannot. A recourse clause simply means that they will include what actions that they're going to take in the event of you not paying. Now, this is important because you should include in the contract, or you should make sure that it is included in the contract, that if you miss a payment, a single payment, there are some sort of mercy for you. Just a single payment should not be end of your financial life. It just, that there should be some sort of reasonable action that allows you to fix things. However, this is recourse clause is that. It basically says whatever they're going to do in the case of a default. So be very careful with this. If it says you miss a payment, remaining amount due, which means that you miss one payment, the bank says, okay, I'm out, pay me the amount, the whole thing, entire loan. So say you bought a house, 30 years, $200,000, and recourse clause says single payment default is cause for remaining amount due, which means that you miss one payment. The company says you owe us $200,000, pay now. In which case you got to find new mortgage, new closing costs, new lawyer costs, it just gets a big mess. So just make sure that your recourse clause is acceptable to you. Now, an installment loan can be a variable rate or a fixed rate. Now, this variable rate, what got everybody into trouble in 2007 and 2008 financial crisis. It simply means that they could change the interest rate based on some economic activity. So for instance, inflation. It could be inflation plus 4%. It could be inflation plus 6%. Now, this is really, really easy to sell. It's really easy to convince people to take this. So they go, a sales pitch is like, look, our inflation is 0, and it's inflation plus 4, and you pay 4%. See how low this is. And look, for the 5, 6 years, 10 years, the inflation is not going anywhere. It looks like 0%. So what? You're going to get inflation plus 4, so you keep paying 4%. And in fact, they're talking about having a negative inflation. So wouldn't that be great if the inflation was negative 2% and then it is negative 2% plus 4, you end up paying 2%. It's just, you could end up paying no taxes, no interest even. But the fact of the matter is, they actually made these commitments very much like this. The sales pitch is very much like this in 2006 and 2007. So when we had this mortgage-backed security crisis, the basis of these variable rates went up so high that people just couldn't pay. So and don't forget, you owe interest on the outstanding balance. So you buy a house, $500,000, and then you thought you were going to pay 1%, 2%, you end up paying 10%, 15%, 20%, just because your economic activity number is outrageously high. Then you simply end up not being able to pay, and you go in default. So variable rate loans are usually, looks very attractive, but know that that's an interest rate that changes, not necessarily in your favor. It can, but not necessarily in your favor. A fixed rate loan simply means that you know what the interest rate is, and it's not going to change. Now, there are ups and downs to this. So let's say that you bought a house at 30 years and you got your mortgage at 6%, and then a couple of years down the road, Fed lowers the interest rate, and now mortgage rates are going at 3%, and you feel like, oh my God, what have I done? I just bought a house at 6%, and my neighbor bought a house at 3%. I'm paying twice the interest rate. Well, you could always refinance. There are companies who refinance with no closing costs, and you could always refinance. It is an awful lot of things to do, so maybe 0.5% difference may not be worth it. But if there is a significant interest rate drop, you can always refinance. But in order to refinance, you should have a clause in your loan that says you could pay it off early. Because if you cannot pay it off early, you cannot refinance early. Because the company who's giving you mortgage is not going to refinance your mortgage. Again, the company who's giving you the mortgage will not refinance your mortgage. You will find another company who refinance your mortgage. What they're going to do is your new mortgage company will pay off your current mortgage company, and then you will have a new mortgage contract with the new mortgage company, which means your original mortgage is first paid off, then you have a new mortgage with the new mortgage company. So if your mortgage or your installment loan is not, you cannot pay it off early, then you cannot refinance it. And there are alternative lenders, and these are different kinds of installment loans, but there are payday lenders, rent-to-own programs, pawn shops, and secured credit cards. But these, your book just goes through them, what they are. They are not really significant parts of our financial system. So this is pretty much all we have to talk about with credit cards, and these 2 videos that we have this week completes our discussion for credit cards, installment loans, and and all related debt discussion. So if you have any questions, please do let me know. And thank you.